Hello guys and girls, and welcome back to my YouTube channel. In today's video, I'm going to teach you about a trading concept that has been an absolute game changer to me when it comes to being a profitable trader, and that is engineering liquidity. Knowing this concept will make it easier for you to know the exit positions in the market where a business transaction has taken place, and this in turn will give you a proper edge to know exactly where to buy or sell in the markets and have a high probability of winning your trades. To understand in depth about liquidity in the markets, you have to understand this simple theory first. The Forex market is a zero-sum game, which means that for a trader or institution to either buy or sell one currency or index pair, it is first necessary that there must be another trader or institution with an opposite position. That means if the banks or the big sharks want to buy a currency or index pair, they will first need sellers in the market. The existing facility to press these positions now, it is what it is called engineering liquidity, or just simply liquidity. In simpler terms, one can also say that engineering liquidity is defined by stop losses. That means where the stop loss exists, it is where also liquidity can be found. Smart money need to activate the stop losses of existing orders in the market so that they can press their positions in the market. For example, lots of traders, when they come first into the market, they get to know how to trade support and resistance. They are taught that they are to buy support and sell resistance. But what they neglect to know is that the institutional traders or the big banks also have access to this knowledge. So what they do after seeing that lots of traders have placed their buys or their sell orders, let's say here, they manipulate the price, taking out the stop losses orders of those positions before playing out. The banks manipulate these prices because of liquidity, but why? It's because banks negotiate very large trading volumes and sometimes find it difficult to find the other side of their trades. So they manipulate the price first so that they can have their positions in the market. And this makes us to know the different types of liquidity in the market. Now, in the Forex market, there are two types of liquidity, which are buy stops liquidity and sell stops liquidity. Now, coming first to know what's a buy stops liquidity. In simpler terms, you can say buy stops liquidity are originated by stop losses orders of sell orders after the buy stop liquidity is taken. That means the market reverses to the downside because the banks uses the buy stops liquidity to press their sell orders in the market. This is a clear example of a buy stop liquidity that has occurred in the market. Now, those traders, of course, who are hoping to sell this resistance right here because they have been taught, lots of books, they are teaching you that you are to sell the resistance. And most importantly, they are also fed with the knowledge that the more the resistance is touched, the stronger it becomes. And obviously at this point, many will press their sell positions in hope that the market will respect the resistance and play out. Now, once the big banks notice that there is a large trading volume here of sell positions, they predict where most of the retail trader stop losses positions will be placed and liquidate all those traders with sell positions. Now, for this case such as this, you are not required to trade. Well, what to do is you have to wait for the price to come back to your area of liquidity and enter your sell positions, because all those guys who were hoping to sell these sell positions right now have been liquidated, okay? They are no longer in the market because their stop losses have been hit already. So what you do is you enter your sell positions and you press your stop loss just being slightly above the area of liquidity, and that's how you can trade buy stops liquidity. Now, one can still ask, like, how can I know here is a price where this resistance, the market will do some kind of liquidity? And the answer to that, you will never know if engineering liquidity will take place at this point. It is your duty as a trader that you have to wait first for the market to liquidate these traders, and you only to come back after the engineering liquidity has taken place in the markets for you to enter your trades. Now let us go and see how sell stops liquidity can be traded in the charts. But first, we have to know in simpler terms, what is a sell stops liquidity? The sell stops liquidity is originated by stop losses of buy orders. After the sell stops liquidity is taken, the market reverses to the upside because the banks now use the sell stops liquidity to press their buy orders in the market. Now, here's a clear example of a sell stop liquidity that has occurred in the market and how to trade it. This all goes to those simpler concepts of support and resistance because that's the information that all new traders, the first thing they've been taught when they come to this career of Forex trading is support and resistance. Any books that teaches you about Forex, in the first 10 pages at max, you will find them speaking about support and resistance. So this is the knowledge that 99% or 100% of all traders worldwide, they know it. Okay. Now, let us get back to this example on the screen that we are seeing right now. Those traders who were hoping to buy this support because they have been taught, of course, to buy the support, and they have been fed with knowledge that the more the support is touched, the stronger it becomes. And obviously, at this point, many would press the buy positions in hoping that this support will buy. Now, again, once the big banks notice that there is a large trading volume here of buy positions at this point, they predict where most of the retail traders' stop loss positions will be placed, and what they do, they enter into the market with very large trading volume. And by very large trading volume, I do not mean the $10 account. These are the big banks. This means they are entering with millions of dollar positions in these same zones that you, a retail trader who you have a $1,000 account or a $10,000 account, you are hoping also to trade that same level as those big banks. Now, one can ask, so how can I know if it's at this point where liquidity will take place? And again, for the sake of those beginner traders, I have to explain this thoroughly so that it sticks in the back of your head. Well, you can never know if the liquidity will occur or not. And the beauty of this, the only beauty of this engineering liquidity is once it occurs already, then that area is likely a position for a high probability setup. So once this price comes back again to this area of support after the engineering liquidity has taken place, then that is a very, very good high probability setup for you to enter into that trade. Now, for a case such as this, you are not required to trade, but what you have to do, you have to wait patiently, no any fear of missing out, the price to come back to your area of liquidity that has taken place and enter your positions with a stop loss being just slightly below the area of liquidity. Guys and girls, I do have a Telegram channel whose link can be found in the description below. Be free to join my Telegram community and be a part of my community in there. And if you have enjoyed this video, please like and subscribe to this channel. Thank you and have a nice trading day ahead. Bye bye.